Welcome back to the Passive Road to Retirement podcast. I'm your host, Andrew Jarrett. Today, we're joined by Russell Franchi. Russell is the co-founder of Village Capital Partners. He's been in commercial and residential real estate for over 20 years and currently focuses on investor relations and financing. He also still works as a luxury residential broker in Florida. He has an exceptional history investing in real estate and some fantastic insights that he's going to share. Russell, welcome to the show.
Thank you, Andrew. Nice to be here.
Yeah, great to have you on.
Thank you.
So, 20 years in real estate so far. How'd you get started and how'd you find real estate?
I've had a little bit of a different road, I guess, to get there. Fortunately, my dad, when I was younger, had investment properties and duplexes as we were growing up. So me and my brother, a lot of times when we were probably like 12 or 13, would go with him on weekends to fix things. So I got a little bit of an education there. Not something that I thought I would ever really make a business out of, but it was good. It was good experience to understand the hassles. When you had to rent it, the phone would ring. You have to meet the tenant there. So I saw a little bit of that at a young age. But I've always had an interest in real estate. I went to college at the University of Michigan. I was a math and science guy. My focus was on likely going into medicine. I got out of college, and before I went to graduate school, I had a really good buddy of mine that said, "Hey, would you like to build a couple houses with me? We can get these lots on an option." And I was 21 years old, and I said, "That sounds pretty interesting." So we went ahead and did that. We got these lots also in Ann Arbor, Michigan, and we built a couple houses. And at the end of the day, we broke about even. It was kind of a tough road, of course, at the time, but we learned a lot. And then after that, I went on to graduate school. I was working on a master's degree in statistics, believe it or not. And it was there that I took a class in the business school, also at Michigan, and it was a real estate fundamentals class. And I just was doing it for my own little interests. And it turned out that there was an adjunct professor that taught it. His name's Peter, great guy. And adjunct professor just means he was a practitioner of real estate in the area. So he would teach this class. And at the end of the class, in the first term, he said, "Hey, you really seem to know this stuff. Would you like to be my TA the next term?" And I said, "Sure." So by being his TA, I got to meet these developers and other investors and other people and bankers. And that really opened my eyes to, this is really an interesting area. Sure. So at the end of that term, I was actually on my way to go into medical school in Chicago. And Peter said to me, "Hey, if you decide not to go, call me. We'd love to, hire you or have you work for our small firm." And I said, "There's no way that's going to happen because I've worked too long and too hard to get here." But sure enough, the winds changed a little bit. I started in Chicago. Things were shifting as to what was going on in medicine at the time. And I actually made the decision to pull out, and I called them and they hired me. And that's really where I started in commercial, just as a, I guess just a beginner really with them. But they had clients come into the office a lot that were multifamily owners, and they owned like student housing around campus. And again, that was another thing. I'm in my 20s, just to kind of learning a little bit more about this. Is such a cool space, because I would be in the meetings where these gentlemen would talk about, we're going to do this, we're going to redo the roof, we're going to redo landscaping, we're going to bump the rents to this because school's going to start again in the fall, but we want to rent in the spring. So it just kind of was a little bit more information for me. And then from there, I went on to found a small lending shop, a mortgage lending shop for residential. And that was, in Michigan and Florida. So I did that for many years. An investor myself, I've invested in a lot of different types of deals. So I've done regular residential construction or fix and flip, some duplexes that had some exposure. And so that was, for a long time. And of course, the 2007 hit, which was very difficult for people like us that are in this area, but got through that. And then coming out the other end, just thought about really looking at how to scale something. And luckily, I met my now partner, Julie Fagan. We were doing a deal together, actually. That's how we met. And she was selling her and her husband owned a vacation rental up in northern Michigan.
Mhm.
And I had the buyer, we talked about it. And then all of a sudden she said that, I said, why are you selling it? She said, well, we're moving more into multifamily. And that's when I said, well, I just happen to have some 1031 money. I'd love to hear more about whatever you have coming up. So she had a deal that was under contract, and it was a 32 unit. So that was our first deal together.
Oh,
We
wow.
did, this was probably about 3 or 4 years ago. And we brought a couple of small investors into that deal. And that was really our first deal that we knocked down. And about a year and a half later, we refinanced it with Freddie. That was our first agency deal with
Okay.
Freddie. And we were able to do a cash out, refi cash out. We got all of our capital back and our investors. And so now we have that deal is, slightly cash flowing, but we have no more equity in the deal.
Nice. Very nice.
And so that's kind of how we got into, where we're at now as I joined forces with her, and we've been building Village Capital.
Mhm.
And we have investors, and we've just been, we've been really working hard at growing our portfolio.
Okay. That's great. So I guess out of all the niches of real estate, multifamily is your favorite, I would say.
I think so. I mean, I've seen a lot, and I've had clients and other, close friends that are builders, developers, can do great.
Mhm.
When things don't go right, those are hard falls, I think.
Yeah.
But yeah, the multifamily space has always been something of interest to me, and it's just a good, solid, stable area to be still with upside.
Mhm.
And you're able to offer your investors something, I think, upfront, where we can offer a 7% pref or an 8% pref, which is great for passive investors.
Sure.
And then we can show them, we are usually targeting around 17, 18, 19% IRR. And it's a great way to, bring in new people that want to passive invest versus maybe a new construction deal that more sophisticated investors are usually in those deals, because they understand that they're going to put their money in, it's going to sit, and then maybe, hopefully in 2 years or 3 years when you exit, there's a fair amount of upside that they will take on that side. So yeah, the multifamily side has been great. We really like it. We're not beheld to that. We still look at other deals like mobile home parks or self-storage. We had a commercial deal that we did. We bought a big commercial building a couple of years ago, and we had a bank as a tenant. And we thought we would get X amount return on it, but along the way we got an offer. We weren't selling, but we got an offer from one of the other tenants, and we worked out a deal, and we sold early, but we still had a great return, and we just kind of moved forward without kind of waiting for the other shoe to drop in the office market.
Mm-hmm. Nice. Very nice. Okay. What markets do you target now? Are you still looking at Michigan, Florida, and
Yeah,
like what kind of
I would
deals?
say our target market. So we have properties right now in Michigan and Texas.
Okay.
And we've been focused on, I would say, the Southeast. I live in North Florida, up in the Panhandle, and Texas, South Carolina, Alabama, Tennessee.
Mm-hmm.
Those are markets that we're focused on, and of course Texas, because we already have a property there, and that one has been doing quite well. Our Texas deal, we only bought that about a little less than a year ago. That was a 72 unit, and we've implemented our business plan, and we're getting it's a great place for that community to have to live.
Mm-hmm.
And our rents are commensurate with the value we're bringing.
Okay. Very nice. Now it's November 2023, right? Rates are up. We are seeing, cap rates, expand a little bit. Are you still a buyer? And, what are you excited about in the market right now?
Great question. Yes, so we're still a buyer. I would say anyone that's in this industry understands that over the last, 7, 8, 9 months, we've seen a big change in this industry.
Mhm.
Part of it is driven by rates. I'd say the biggest thing that's making deals difficult to get over the finish line is a combination of two things. The first one is sellers are still tied on to the values they thought that their properties were about a year ago. And they're just stuck on that. I think once they see that a broker says to them that they can achieve a $7.5 million sale price, that's what they are looking at. They're not looking at anything else.
Yep.
Whereas, and then the other piece is, the rate. So the rates are higher, which makes it a little bit more difficult. And so those two things together are making it tough for deals to get done. I'd
Mhm.
say the other thing that's of interest that I was going to mention, we're in the middle of a deal right now, which is our largest deal. We're buying a 70 unit in a resort area in northern Michigan. It's a $12 million deal. We've been in for agency debt. We're almost there. We're supposed to close next week.
Nice.
But what's changed is when you talk to Fannie now, they don't, or Freddie, they don't say, oh, we'll give you 75 LTV or 80 LTV based on the age of the property or anything. It's
Mhm.
all based on debt constraint and the debt ratios. So now they're all kind of stuck at like 60% LTV, maybe 65% LTV if you're lucky. So what does that do? It makes it more difficult. Now you have to raise more money. You have more to pay out to investors, and it starts to whittle down your return.
Sure.
Thankfully, on this deal, our returns are still really good for our investors, and we're looking forward to closing that. But it was a real rough 3 months of doing this deal because Fannie and Freddie are they're just really strict right now,
Yeah.
and it's tough to get strong loan amounts from them. So yeah, so answer your question, we're buyers. That's the most recent one we're working on. We're almost there. We're excited about that property. We have
Mhm.
all the money raised.
Nice.
Our investors are also excited about this property. They know the area. It's in Traverse City, which is near some beautiful lakes up in northern Michigan. And there's a lot of professionals that live there now after COVID. So the incomes are really strong there, which will help drive our business plan on that deal. But outside of that, I would say the big shift is going to be, like in 2024, we had a meeting this morning that I think we're going to be really focused on, if other deals make sense, we'll certainly look at them, but I think we're going to see more distressed deals coming down the pipe, and we're going to see more, deals that just that investors, or I'm sorry, sponsors that took on bridge debt 2 years ago
Mhm.
at that great 3.75% rate
Right.
for like 85% LTV
Mhm.
those are resetting. And if those are resetting to 11% or 12%, unless they bring a $2 million capital infusion, they're going to
Right.
have trouble on those deals. So those are things that we're watching for to kind of be there to kind of step in and either help out or take over.
Mhm.
So we think that there's going to be more of those coming. We all know there's hundreds of millions of dollars of bad debt that's going to kind of hit the wall, I think, in the next,
Yep.
12 to 18 months. So I think
Mhm.
that's an area that we're going to, keep an eye on.
Hey, everyone. Hope you're enjoying this episode. Are you ready to maximize your real estate investing to its full potential? Send an email to andrew@jarrettcapital.com and take your life and business to all new levels. That's Andrew@JARRETT capital.com. Yeah. Yeah, I agree with you. There's a lot of deals coming, and I'm starting to see more deal flow coming through now already. Some distressed, but I think next year will be quite a bit. And I'm buying now too. Like you said, rates are higher, but when rates drop and you refinance out, that's where you make, pretty good return.
Yeah, and I think another thing to remember is, we thought the rates would be in the sevens, frankly, but
Mhm.
by the time you look at the Fannie rates for multifamily, as long as you hit that $7.5 million mark, I think once you're over that, you're in
Mhm.
their premium pricing.
Right.
So the rates we're seeing right now are in the mid sixes, maybe 6.3, 6.4,
Mhm.
which is great compared to a residential rate. I think most rates we see there are over 7% right now. And of
Yeah.
course, with Fannie, even though I'm telling you the struggle to get through it, and I know this stuff because I've done it for so long.
Mhm.
Their terms are still really, really strong. I mean, they still give you a 30-year amortization. They're going to give us 2 years interest only. The rate is reasonable. It's just you have to go through you have to go through the obstacle course to get to the final line.
Yeah. Yep. Now, as you said, you've been doing this, over 20 years. I guess in that span of 20 years, do you have a deal that hasn't gone as planned and kind of maybe some lessons learned from that?
Great question. Yeah, I would say that if I can think of one, I guess more recently, most of our stuff has been going pretty well. There's a couple I think that probably took a little bit more capital, I guess, to put in to get it to where we wanted to go. So what we did was Julie and I, my partner, who, for our partnership, again, I'll make one comment on how important it is to have a strong complementary partnership. She already had a portfolio before her and I met. So she's a very well astute investor, and her and I just see eye to eye on most of these things. So she's really great on the front end. So she'll help find the property. She'll analyze the property. If it looks good enough, then we'll review it together. And if it's a deal we want to go after, then we'll both do the purchase agreement. I'll usually take over from that point, finish the negotiating, raise the money, get the loan, close. And then she has a strong background in management on the property management side.
Nice.
So I think that's a key thing. So in the deal that I was just referring to, there's a little bit more capital expenditure than we thought. So her and I basically had to write checks to get this stuff done. Maybe let's just say to the tune of about 100,000. And so we just did that. We have investors in that deal, but we didn't do a capital call. We just figured this was our responsibility to get this stuff done. Sure. So we wrote the checks, got it done, and now we're in the process of we're going to either refinance it or we're going to get a light line of credit. We have an approval of maybe $130,000 line of credit. And if we can do that, then that'll help recoup the money. But I would say that was one of the ones that we had an idea of what it would cost. And we're usually pretty much on top of that. Her husband is a contractor, so he helps us with this, and we're usually spot on. But this particular property just had more to it than we could see as a buyer. It wasn't until we really got in there and saw what was going on with the roof and some other things that just needed more money involved. But it wasn't too bad. But of course, it's always good to be cognizant of that as you're approaching these deals.
Sure. No, that's good advice for sure there. So I guess do you have any daily habits that you do that kind of help you stay on track and motivated to keep buying more properties and continue along?
The couple of things that I do is, well, first of all, my partner and I, Julie, we have Zooms probably the first 3 days of the week. So Monday, Tuesday, Wednesday, we have Zooms in the morning. I think working out is probably the number one thing that I love to do. To get that knocked out, because then it just gives you the energy to focus and get after everything. And I would say, those things, and just keeping a good task list, really, because there's so many things, as you must know, there's so many variables and there's so many moving parts to these deals that you just have to keep a really tight list of where you're at, what you need to be, pursuing. And then of course, with this business too, there's always an ongoing, we have properties already. So we have to, we have to jump into calls on our existing properties with the manager and just understand where are we at, what are the rents going at, and just kind of keeping a finger on the pulse, which we really like being involved in that and kind of seeing that, our business plan is being implemented properly. Our rents are being pushed reasonably for the marketplace. So yeah, I would say just the standard, working out, a lot of communication, and really good checklists to make sure you're hitting everything. Because, on any of these deals that you're getting financing on, the checklist is long. And when you miss anything or a few things, it could set you back a week or two. I mean, even on this deal I was just telling you about, our attorney asked where our survey was because he didn't have a copy. And all of a sudden the lender was like, well, we can't do anything if we don't have a survey. Well, we had the survey, but it just wasn't uploaded and they didn't see it. So we got that. But again, we didn't have a survey, that would have pushed us back another couple of weeks just for something silly like that.
Yeah. Yep. Always something.
Right.
So
for sure.
What would be your top strategy for somebody newer to real estate, maybe just trying to get into multifamily, or real estate in general, to create that first stream of passive income?
I would say that, when I got started in multifamily, before I met my partner now, I just had a buddy that just said, hey, I have this family friend and they've been doing multifamily. I trust them. And, you want to put in $100,000 into this deal. It was in Michigan. I knew the area, I knew what the price was going to be, and I knew the building. So I do most stuff at my desk. I'll usually go and kick the tires at some point and look at the property. But that one in particular, I really actually didn't go visit that one. I knew enough about the area. I looked at the valuation. And so I would say for someone new is to educate yourself, number one. And then number two, do your first deal with a sponsor that knows what they're doing. There's just too many pitfalls in this business, and you can't trust anybody. You can't trust brokers. You can't trust sellers. You really need to do all the due diligence yourself. So what I would say is if someone has 50, 100, 200,000, I would say find a group that they trust, a sponsor, and get in that way, because once you're in there, the book is open to how this business works and what you're looking for.
Right.
And what the valuation is, where is the rent in that market right now? Where can those rents go to? What's the value, or what's the cost going to be? How much is the debt? What's the LTV? And I think those are things that an investor should be looking at. But I would absolutely say start your first one with a sponsor that you are comfortable with, that you've vetted, and that's just a great way to start in this industry, I think, because then you get a bird's eye view from what's going on. You have an investment, you get some passive income, you get all sorts of tax benefits. And then, if you like that, then maybe you start to go look at doing some of your own deals. Again, I wasn't one of the ones that did single family and then duplex and then triplex. I really just went from lending, like a lending business, and understanding just regular real estate deals. And I did some luxury vacation rental type stuff on the beach. And that's kind of where I did a lot of my investing up until, like, let's say 2019, 2020. But since then, I'm still really bullish on multifamily. Also, there's such a need in our country for good housing. I mean, some of the stuff we look at is just terrible. And I think in many ways, I do feel like even though we're getting money back to our investors, Julie and I are excited about what we're doing. We feel like we're bringing value to new tenants. But I think overall, I think we're also doing something good for our country, because I mean, the cost to own a house today is prohibitive for a big middle part of our country, and that's going to stay like that for a while. So if we can improve our properties and really bring a better community to people, I think both Julie and I feel really good about that part of what we're doing.
Yeah, no, I agree. And that's a great point. Kind of, learn as you earn, kind of ride the ponytails of somebody and the coattails, and, kind of make your money while you're watching what's going on. It's a great way to go.
Right. Yeah, exactly. And then I mean, I've seen before too, where people that start like that, sometimes they stumble upon a deal and it's a mom and pop and they're not really sure what to do either. Well, now that they've had some experience with that sponsor, they could say, hey, can you guys look at this deal and see if it's a good deal? And that's another way to kind of maybe become part of the GP or have a bigger piece of the deal because you brought the deal to the table. I mean, that's a great way to kind of get started. And then once you cut your teeth on one or two, then I'd say it's worth it to go out and do it if that's what investor wants to do.
Sure. Yeah, no, I totally agree. And to your point as well about, kind of improving properties, we are very undersupplied and probably will continue to be on, new units and everything. So renovated existing units is a good strategy.
Yeah, I think so. And I think that, there's more, I think, coming in the pipe to be built. But of course, as you know, the cost of construction is so high. I mean, those numbers are coming out so high that, buying that class, I mean, our focus is really on like the class B light lift and do a lot in the management side and marketing and just get it to the right people. I think that's a real key area. The class A will always be strong as well. But the class A people, you may lose some of them to home ownership at some point. And hopefully, you really want to have home ownership in our country. I mean, it's really at a disadvantage for a lot of people right now. So I think if we can step in and serve this market right now as we are, again, I just think there's a lot to be done there, because most people cannot afford really nice brand new class A construction. It's just not going to be in their budget. So being in that position, like the one off or the two off from that, I think is a huge market to fill, across the country, really.
Yep. Great point. Now, Russell, if people want to reach out and contact you and learn more about you, where can they find you?
Our website is villagecapitalpartners.com. And we're on Facebook. Again, on Facebook, we're Village Capital Partners. And, my name's Russell Franchi. My partner's Julie Fagan, and we're accessible. We'd love to talk to anyone. And a lot of what we do too is we educate a lot. I mean, we talk to people, we explain to them how this works. And of course, our investor base, that's a key part of explaining to investors, what we do. And again, for us, our investors are probably the most important. We make pretty much every decision based on our investors and how we're serving our investors And that's another, key piece. So yeah, I guess our website's probably the easiest place to go to.
Okay, great. And last question before we get into our 5 to Thrive section. You could step in my shoes for the interview. What's one question you would ask yourself and answer that I didn't ask you?
Good question. Let's see. I would say a good question would be, why does it take so long to scale? I guess would be a good question.
Yeah.
Because people that get into multifamily want to scale. We want to scale, and we're working on it. Most of the deals we have, we started with a 32 unit, then we did a 54 unit, a 52 unit. We had a fire along the way, fought the insurance company. Then we bought a 72 unit in Texas, and then a group of single family, like a package of 38 units. And then a couple of really unique deals that were like 20 units in these like downtown loft areas. And now we're on to a 70 unit for the Traverse City deal. Well, people always ask about scale. So I guess my question to myself would have been, how do you scale faster, sooner? And, there are ways to do that, because you really want to get to 100 unit properties, because that's really where you get the balance of management, and it's just more efficient.
Right.
But of course, those properties are a lot more expensive. So my answer would be, it's good to just try and push yourself to get to the larger project. It's going to take more work. It's going to take more raising money. But I think that you also have to be measured to some extent. So my answer would be, it's good to be aggressive. It's good to be worried about scale, but you really have to be, tempered with what you're buying, and make sure you can get deals closed and manage those and deliver a good return. So the answer is yes, be concerned about scaling, but do not, run out of your way to go scale just to scale. I think you have to scale methodically and properly, because remember, you have a lot of people's hard-earned money in your hands, and you're the steward of that money. So if you're just out, oh, I want to get 1,000 doors, I mean, that's great. And some people may do that, but I would say it's really important to still take those measured moves to build it with a great foundation, so that when you do hit it, you don't have to look over your shoulder and worry about deal number 4 that you kind of rushed to judgment on and you paid too much for, and now it's underwater.
Right.
We're really aggressive, but we're measured in the way we're taking deals down.
And that's great advice. Kind of build on a solid foundation, right? Instead of
right.
Yeah.
Right. Yeah, exactly.
Yeah. No, totally agree with you on that. So now we're into our 5 to Thrive. So this is the word association game. So I'm just going to rattle off 5 words and just give me the first word or phrase, sentence, whatever comes to mind, based on that word.
All right.
All right. So here we go. So the first one is wealth.
Wealth. That's a good one. I would say achievable.
Lifestyle.
Well thought out.
Nice. Inflation.
A necessary enemy.
Multifamily.
Exciting.
And Village Capital Partners.
Village Capital Partners. Growth.
I like it. Good answers.
You got me on the spot here.
I know. That's the best. That's the fun part of it, right?
Yeah, no, it's great. It's great.
Well, thanks, Russell. I really appreciate you coming on and sharing your knowledge. It was great to have you here.
Great. Thank you, Andrew. Thanks for having me.